Tom Lydon, and welcome to the NEOS Monthly Income Podcast. I'm also joined with Garrett Paolella and Troy Cates, who are the co-founders of NEOS. Gents, welcome. Good seeing you.
Good to see you, Tom.
Yeah, good to see you, Tom.
Hey, guys, we got a special guest today, Tyler Ellegard, who's the portfolio manager at Grady Investments. Tyler, welcome. It's great having you with us.
Thanks for having me. Excited to be here.
Listen, we can kind of tell by your cool setup that this isn't your first podcast. We want to hear about that, but first and foremost, tell us a little bit about Gradient.
Yeah, so we are a third-party money manager. We manage about $7 billion for advisors across the country. We have a number of different strategies through separately managed accounts, whether it's income-focused, fixed income-specific focused, equities. We have portfolios that range from using individual stocks to ETFs to alternative ETFs. So we kind of cover the gamut of portfolio management and offerings to our advisors that we work with.
So guys, you know Tyler, you've talked to him before. What's unique about what you know about Gradient and kind of the way they go about the market?
So we've known Tyler and Gradient for many years. I think one thing that you get with Gradient, and Tyler's definitely an institutional focus on money management, right? We spend a lot of time talking to various investors from all different walks of life. And one thing we've really enjoyed working, with Tyler on is how knowledgeable they are about the markets, not just equities, not just the sector, ETFs, portfolio construction, diversification. And so when we're having a conversation, whether that's about income, risk, we could basically break down anything. And Tyler's and his team is going to have suggestions on how to look at the markets, how they view the world, how they manage money for investors. And so I think that's definitely unique relative to a lot of people that we work with.
Tyler, as a portfolio manager, what does that mean to you, especially with the uniqueness of Gradient?
Portfolio manager in the finance space can mean a lot of different things. So for me as a portfolio manager, I have specific mandated portfolios. So whether that's a large cap value stock portfolio, I have to be making sure that I'm buying dividend paying value companies in that portfolio only. I can't go buy an Amazon or a Google or companies like that, right? I have a specific mandate. And so all of our strategies that we have here at Gradient, we have a portfolio manager, someone that's making those key decisions on which stocks to buy, which ETFs to buy, and making sure that portfolio matches what the mandate is and what we've told our advisors it is going to be. So as a portfolio manager at Gradient, it's really making those big decisions on the portfolios that then get allocated across all of our client accounts.
Troy, you're talking to advisors like Tyler all the time, having so many different models, 30, 40 models. It's not easy to manage all those.
No, it's true. I mean, I guess, thinking about it, Tyler, you talk to so many advisors, you're talking to so many investors. Is there one common financial mistake you see either the advisor making for their clients or whether it's the end investor making that even the ones that are financially savvy that you could help them avoid with the portfolios that you're putting together?
One that's actually top of mind right now is sell in May and go away, right? I mean, I think when we talk to advisors, whether it's times of uncertainty or just those type of market idioms, I think we see a lot of advisors making the mistake of going to cash or following those idioms. And I think what we always try to pitch is it's not always about timing the market. It's more about time in the market, right? If you're going to be invested to a long-term plan, regardless of, hopefully my mandates provide that client with what their objectives are trying to do. But at the end of the day, if they stay invested to that longer-term plan, they're typically going to be okay, right? If they start to do these little timing things like we saw in April, maybe they tried to pull out of the market on April 5th and all of a sudden on April 7th or April 8th, the market snapped back 9.5% and you miss out on that, right? So just staying focused on their long-term plan rather than saying, is my portfolio going to beat the S&P or am I super concerned right now about the current administration or whatever it might be, whatever those concerns are. Those are the mistakes that we see when we're talking to our advisors and our advisors' clients is they get worried about those things rather than focusing on the plan that they've put in place 5 years ago, 10 years ago. Chances are they're probably ahead of plan, but chances are that plan is going to help them get to those long-term goals if they just stay the course. And so those are probably the biggest mistakes that we see over a longer period of time.
Yeah, Tyler, this is the Monthly Income Podcast. So as we're talking about income, and now we're just, months away from highest rates that we've seen in 20 years. How does Gradient look at income today? And are there strategies that maybe they didn't implement 5 or 10 years ago?
Yeah, I mean, I think everything starts with what risk are you willing to take to get the income that you might need, right? And that's really our baseline when we're looking at income portfolios or allocating those income portfolios that we have for clients, because you can get a lot of income from various different products or investments. I think number one, obviously NEOS, right? I mean, you guys provide clients with, I would say, enhanced income, but then you can also buy your typical fixed income treasury ETF, or you can buy your corporate bond ETF. There's a number of ways to go out there and get that income that you might need. But from our starting point, when we're looking at the mandates, is how much risk are you willing to take right now? Are you only willing to take the risk of a U.S. Treasury and only taking the risk of interest rates, right? When you're in an ETF, it's more about interest rate volatility than anything. But over time, are you only willing to take that risk of U.S. Treasuries? Because we can get you income from there, but a 1 to 3 month Treasury ETF is paying 4.3% right now. So is that income satisfactory enough to meet your objectives? If not, then we need to start looking at how can we produce income or enhance income on top of that to meet those goals. And that's where you can find different things of you go up the risk curve of investment grade, high yield. And then if you don't want bonds, because we all consider bonds to be safety, right? That's been the historical trajectory of bonds, is it's your safe bucket. But we saw in 2022, bonds are not necessarily safe, right? Bonds finished the year down 13%. Most people who are in a risk-off bucket did not expect their portfolios to be down that much. So then you start to look for other alternatives. And so that's where option income ETFs become very important in an overall income plan, because they can provide that enhanced level of income to meet those client goals. And so knowing that it can do that, but also knowing that you're still taking on some of the risk of maybe the S&P or the NASDAQ, how badly do you need to get that income? Also, how does it fit within the overall portfolio to diversify your risk? So you compare some of these with maybe you only need 25% of the portfolio to be in a high producing, riskier asset, and you can take 75% in a lower income producing asset, but a little bit safer. That's kind of how we're looking at the universe. But in the recent years, we've seen this explosion of option ETFs that provides you that additional premium or additional income that a client needs, which I think has been a fantastic opportunity. And we've seen, obviously, we work very well with NEOS. We've been able to talk to Garrett and Troy quite a bit and understand their products. And as much as they say that we're knowledgeable, I mean, they're probably the reason that we are knowledgeable about this space. But I think overall, generally speaking, it's very different now with what they've been able to come out with versus probably at what I would say pre-COVID times. And so the income that you can actually generate now in these types of products is fantastic, but you also have to be safe. I think there's some out there that I don't want to bash on anybody else, but I think there are products out there that are maybe a little bit riskier based on the headline incomes that they're throwing out there. So you have to know the underlying products, which is why we've worked with Garrett and Troy so closely, because we needed to understand how the underlying products work and how we're getting the income. But generally speaking, now is way better from an income standpoint, or very different, I should say, than probably pre-COVID.
Yeah, Garrett, obviously Tyler's cutting edge. I mean, he's managing different models. He's also helping making portfolio decisions, also very, very comfortable with the options overlay strategy and the enhanced income. He may not be your average advisor out there. As you look at working with Tyler and advisors like Tyler, who have not been concerned or in any way about the options market, where many advisors still don't want to even put their toe in the water because they feel like 10 years ago it might have not been as liquid or a little bit more risky. How would you encourage an advisor or an investor to maybe dig a little bit deeper and use their knowledge to their benefit?
Yeah, listen, I think it's all around education and spending the time to do your research. As you know, Tyler's mentioned, but also just like as we think about the market today, if we just talk S&P 500 index options or just S&P 500 options as a whole, right? The average daily notional traded in an S&P 500 option contract, just in general, so ETFs, index options, is now averaging around 2 trillion a day, right? Which is a tremendous number. If we probably told people 5 or 10 years ago that $2 trillion moves on a daily basis through an S&P 500 option, not even just all the options out there, it's been a growing space. But I think what advisors have started to learn over the last 5 years or so is that these products can produce alternative outcomes within their portfolios. It can meet that enhanced income level. We obviously focus a lot on tax efficiency here, which I think everyone on our channels know. There's other ways to espouse, right, Tyler's views or an advisor's view to the market, whether that be hedging. And so this space as a whole with these option-based products has really grown not just in income, but also kind of defined outcome or building a structured outcome for the investor's portfolio. But what I love Tyler talking about is something we spend a lot of time speaking about, just even amongst ourselves, is right, manage to the client's risk first. Like, what is the client's goal? What's their estate plan telling them? Then back into the rest of it. There's a lot of ways you could leverage either, NEOS products or other products to build a portfolio. But we love talking to investors around like manage and understand the risk first. And so we spend a lot of time trying to educate, and it's worth the time. Learning about the products, learning about what they do, what they don't do, where they can complement the portfolio allocation, what, Tyler or any other portfolio managers looking at for their clients, right? They're great tools to now add into a much more, diversified or much larger toolbox to construct that portfolio for investors.
I just want to jump in here because Garrett brought up a really interesting point, whether it's for a hedge strategy or income strategy. And we've actually used SPYI in both ways, right? So we've used it in a hedged equity sleeve of our portfolio to protect on the downside. So coming into the year, we had felt the market was overextended and we wanted to protect some of our clients' assets. And so what best way to put together a sleeve within an overall model, and we called it a hedged equity model. And part of that model was SPYI because it allows you, as much as SPYI tracks the market on the downside and the upside, which is what we love, that income allows you to offset the downside. And so we had SPYI as part of a hedged equity bucket. But then on the flip side, in one of our high income producing portfolios, we use SPYI to generate that premium income for our clients. So we've used it both ways, but just knowing how it works, I think, is the important part.
I think the secret sauce here, as Garrett illustrated, and kind of what you're saying right there, is education, understanding how these work, having confidence, and also putting them to work in different ways. But you've got an added challenge. You've got over 400 advisors out there that may be interested in these models, especially if they're seeing this high monthly income. How do you handle their education? And then most importantly, giving them enough education so they can educate their clients?
Yeah, I mean, it takes time, right? I mean, it takes a lot of time, especially as these newer products come out. We put them into the portfolios after we understand them. Right? We're not going to just put something into the portfolio that's new and flashy. We and the rest of my team, my colleagues, the other portfolio managers, our analysts, we all need to be able to understand the product first. We're just not going to put something in there that has a flashy distribution yield, and we have to understand how that process works first, and then we'll introduce it to the portfolio. And as we get those calls from the advisors that are heavily using our higher income producing portfolio, then it's having that conversation with them because they may say, why is this yielding so high? We put SPYI into our common stock bucket. We bucket equities, fixed income, alternatives. And they say, how can you get 12.3% yield on common stocks or on equities? And so then we start having that conversation about education. The other part of it is we do a lot of trainings in-house with advisors. So we'll bring our advisors into our building and train them on a 2.5-day thing through our various portfolios, marketings, whatever. But it's all about training. And as those questions come up, we all have to be knowledgeable on the product itself. So it's not as me as the portfolio manager as our high income producing portfolio. It's not just me knowing what the product does. It's making sure that the rest of my colleagues, the other portfolio managers, the other analysts all know how that product works as well. Because if someone doesn't and they get a call on it, right, that creates an issue. So if there's these new products that come out, we all have to understand it, know in depth how they work, and then we can introduce something like that to the portfolio.
Do you have a lot of your advisors viewing your weekly podcast, Tyler?
I would like to say we do, right? Hopefully they do. Hopefully they watch it. But yeah, I mean, we come out weekly with basically whatever we're talking about at our desk for that day or that week. So we do a little bit of prep, but generally speaking, it's what are we seeing in the markets? What do we think about it? Is there an interesting topic? It's been somewhat hard lately to get off of tariffs, unfortunately. But yeah, I would like to say that our advisors watch it.
Well, Troy, any final questions for Tyler?
Yeah, I guess I just wanted to rewind a second. As you were talking about looking at all these new products coming to the market and your team evaluating them, is there a specific process that you guys have as you're looking at, hey, there's another option-based ETF or there's another one in this space? Is there a kind of a process you guys go through as the team looks through it to see, is this worthy of being in the model at some point as it continues to grow?
Yeah, I think part of it is just getting on the phone with the actual company. And I would say we're at a big enough size at this point where we can get a lot of the portfolio managers of that specific product on the line. Whereas if I was just a normal investor, a lot of times you can't have that type of access. Maybe you guys think differently, but I would say the size that we're at now, being the size that we are in the ETF space, it allows us a little bit more access to the actual product team, the actual portfolio managers who are running these strategies. And so it allows us to have those conversations with them first. And that's exactly what we do, is we get on the phone with them and understand what is the actual process behind it? How much of the portfolio are you writing against? How far out of the money are you writing your calls? Are you using a different type of strategy? When are you rolling those calls, right? There's a lot of things that go into it, but just understanding the full process of these new products, because everything's going to be a little bit different because nobody wants to copy each other. So there's a few nuances between some of the products, but just understanding the ins and outs and doing the due diligence up front before we introduce anything to our portfolios.
Well, gentlemen, this has been great. Tyler, I'll tell you, I see that you're living in Minnesota. I got to say, they're the nicest people in the whole country there. And obviously, you're a great example.
So that's why you guys brought me on the podcast, was because you knew I have nothing but nice things to say.
It's awesome. But this is really, really helpful, and it's great getting your perspective. And congratulations on all the success at Gradient and all the things that you guys are doing. And on behalf of NEOS, thanks for that great relationship. It means a lot. You'll have to come back for another session with the Monthly Income Podcast.
I'd love
Things
to.
are evolving, and as we develop more product, it's really important to get your feedback. So thank you.
Absolutely. Thanks for having me.
Gentlemen, thanks. We'll see you next month.